Is the price of gas being manipulated? Are you being scammed by the world's most powerful oil players? Probably. So let's discuss that topic in today's video. Let's talk about the global oil markets. What are the factors that could see oil prices move much higher by the end of the year? Well, first, it is important to understand that a major mechanic that drives and controls the price of oil is the futures markets. Now, this is where buyers are basically going out and agreeing to purchase barrels of oil at a predetermined price on a predetermined future date. Thus the idea of the futures markets. The futures market is where the price of oil gets set. So it then comes down to supply and demand, which play a big role in influencing the price that gets paid by the people in the futures markets. The following four factors tend to have the biggest impact on those market prices. There's OPEC Plus, which is a cartel of countries, which Saudi Arabia and Russia are the biggest oil producers. Now, this group of countries, they actually set production levels for the world, so they massively control the price that you will pay at the pump. The second is the global economic performance. Typically, a growing world economy will drive demand for oil, which will push up the price. A recession will lead to, well, basically the opposite, a fall in demand, which will drive the price down. The third factor we have, of course, is oil reserves. So if the demand for oil falls and production continues, well, oil reserves will eventually be topped up. Now, if there is too much surplus oil being produced, that will actually then lower prices down once again. Now, the fourth factor, of course, is renewable energy. So over the long term, renewable energy should reduce demand substantially for oil as renewables continue to make up more and more of the energy mix across the world. But that's, we're talking years and years here, right? Prices will go down, though, as more and more renewable energy becomes available. That doesn't really help us for this winter. Oh, and by the way, you'll find this funny. The irony with the oil markets is that only around 3% of the participants actually go on to buy the barrels linked to their futures contracts. That's right, you heard it correctly. The oil market is largely controlled by speculators, not real buyers. So what are the primary factors? The factors which could see big price increases happening by the end of the year. Well, let's start off by talking about the SPR, or the Strategic Petroleum Reserve in the USA. You see, the US Democratic Party are currently focused on retaining power in the upcoming midterm elections. So what they are doing is playing a short-term game, releasing oil from the country's emergency reserve stockpile to lower oil prices artificially before the election. And then after you vote, they turn off the faucet, meaning that price increases become very likely when that happens. Now, this chart here underlines just how fast and crazy the decline in oil reserves has actually been in the USA. The Biden administration has diminished the SPR by about 36%. That's crazy. This is being done, of course, because gas and diesel prices have been soaring for most of 2021 and 2022 due to a combination of factors, particularly the overhang from reduced production during the height of the COVID pandemic, and of course, the Russian invasion of Ukraine. And now we are starting to see headlines like this one popping up. The US now has just 25 days of diesel supply left. And of course, to be clear, if diesel markets get hit bad, then everything gets hit because commerce largely runs on diesel. By the way, releasing the SPR reserves of oil is, of course, an attempt to win votes in those midterm elections, but it's actually a bad long-term idea because the USA is going to have to replenish those reserves, which were bought very, very cheaply previously, meaning that if the prices of oil keep going up, they have to buy at higher prices. Next, let's talk about OPEC and OPEC cuts in supply. OPEC is the organization of petroleum exporting countries plus Russia. In reaction to the US's tactics of trying to add supply to an already tight market, the OPEC Plus members have endorsed an output cut after a US coercion accusation. So the 13 OPEC countries, Saudi Arabia, UAE, etc., and the Plus, which is Russia, they all came together a few weeks ago to announce a big cut an agreement between the nations that they would be cutting the production of oil by 2 million barrels per day, which is a lot at a time of an energy crisis, right? The decision was said to be unanimous among the members, which makes sense. They want more money for their oil. The energy minister for the UAE said that it was a purely technical decision, no politics involved. But yeah, I call BS on that. Really not so sure about that statement there, buddy. You see, Saudi Arabia isn't too happy with what US President Biden is doing right now with the strategic reserve release. It's manipulating the market. The Saudis do not believe that any nation, except for OPEC, of course, should be using their oil reserves to manipulate prices. So now the OPEC countries seemingly want to make sure that the USA feels a bit of pain for having the audacity to release these strategic reserves over the coming months. They're cutting their production. That's going to lead to a spike in oil prices over the winter months, or at least it's very likely going to lead to that. Many major economies also have lower than normal oil supplies, so cutting supplies at this particular time causing great concern around the world, especially within the USA. Now, those economies are now going to be forced to spend more money on oil in a bid to try to secure as much supply as possible, putting themselves in further economic trouble and, of course, driving prices higher as all these countries start scrambling for, well, less available supply. Now, before telling you about the Russian oil cap, what the China situation is, and what could actually happen this winter to the price of oil, I just want to let you know about my weekly cryptocurrency investor newsletter. It's called Wealth Mastery. It's jam-packed full with alpha on altcoins, airdrops, NFTs, DeFi tutorials, market analysis, and much, much more. Join our 50,000 weekly readers by signing up for free using the link down below in the description. So let's talk about the Russian oil cap. You see, the European Union is going to drive up the price of oil this coming winter, largely because in December, there is a cap which is going to be imposed across all EU member countries on the imports of Russian oil. EU countries will have to cut down on Russian imports by between 1 to 1.5 million barrels per day. Not only will this mean that the EU is now going to have to go out and source oil from other countries, which are farther away and it's more difficult for them to get from, putting more demand on an already tight supply, they're also going to end up facing longer wait times to get that. Also factor in, of course, the risk of sanctions being imposed on ships that are carrying Russian oil. And that will take ships out of the market as well. Lots of variables here. Typical wait times for oil shipments from Russia into the EU right now are like 3 to 4 days. When the cap comes into force, those wait times could go from 30 to 50 days. This is going to put major downstream pressure on supply chains, which is going to ripple right through to you, the consumer. It's going to hit consumer prices. Gosh darn it, every time, don't they? Anyway, let's now discuss China's zero COVID policy. Now, China is the biggest importer of oil in the world, but their zero COVID policies will likely impact their oil demand for the foreseeable future. So we have much less demand out of China right now because of the zero COVID policies. However, when China does get back to fully functioning, and it will, demand will spike like crazy. There's no doubt about that. The only question is, well, when is that going to happen? Well, with President Xi taking a third term at the CCP, anything is possible, which leaves a major spike in Chinese demand as a wild card, a massive demand spike, which we flipped on at any moment. So could oil prices soar this winter? How will this affect inflation and you? Well, given what is going on right now in the oil market, the upcoming supply squeeze will likely only mean one thing. Prices will go up. The Saudis are hoping to keep the prices around $90 to $100 per barrel. But let's keep it real. The effects of turning off the strategic reserve faucet, it's a big impact. The Russian oil cap, big wild card as well for the price of energy this winter. But don't forget who is going to bear the cost of all this. The consumers. You. Oil is used heavily in the transportation of goods all around the world. And the more that oil prices go up, the more expensive goods become. This could be a new wave of inflationary crisis, right? So we should expect a tough winter period with those inflationary pressures not going away until next year. The rise in oil prices could send US inflation up again. EU inflation rates, they just keep hitting new highs, but could keep going even higher, all of which could be very bad for orange coin, dog coins, monkey pictures. Although if no one can afford to go anywhere because it's too expensive to buy gas, then maybe they're all gonna be stuck inside trying to get rich, trading crypto, buying monkey pictures. We shall see. Maybe a silver lining, right? Okay, that's it. Subscribe now. See you next time.